morning, one and all. I am delighted to extend a warm welcome to all of you in 14th Quality Cafe session on Saturday morning. And we have a very important topic based on SA 570 going concern, filled with insight discussion, presentation, and opportunities for meaningful exchange of ideas. Before we proceed, I would like to uh, introduce CA Vishal Doshi sir, convener CAQD, who will be guiding us through the proceedings of this audit cafe. Vishal sir brings a remarkable depth of experience and knowledge in auditing, and we are privileged to have him leading us today. Additionally, we are also fortunate to have CA Shri Priya ma'am, Deputy Convener CAQD with us, who will be playing a pivotal role in ensuring the success of this cafe. She'll bring a diverse range of skill and insight to the table, and we are confident that the contribution will greatly enrich our discussion. So now I would like to hand over the microphone to Vishal sir to begin the session. Thank you all for your presence, and let's look forward to a productive and engaging session. Vishal sir, over to you.
Thank you, Karunaji. Very good morning to all the participants who have joined this 14th Quality Cafe on a very important topic on going concern. The topic is assessing the reliability of management's going concern forecast, methods and consideration for auditors. I have with me the Deputy Convener of CAQD, CA Sri Priya Kumarji, who has been a great support to this directorate this year, where we have been coming out with a lot of tools, templates, checklists, and all those things in support for the auditing fraternity. And she is always there to help and guide me in this journey. We have a very eminent panel today on this going concern topic. We have with us our respected past president, Nihar Jambusaria ji, our past Central Council member, CA Abhijit Bandopadhyay ji, and a very esteemed colleague, CA Asim Trivedi ji. So with this panel, we are going to discuss on the going concern. Friends, as auditors and financial professionals, we understand that in the assurance, the concept of going concern, it is very important, and it represents a company's ability to navigate uncertainties and sustain the operations to the foreseeable future. It is a principle that goes beyond numbers. It is a reflection of a company's ability to sustain its operations, adapt to changing circumstances, and endure the unforeseen circumstances. I would like to share over here that in the recent past, the going concern was much talked about, especially in the COVID-19 environment, where there was a lot of uncertainty, and there were a lot of questions regarding going concern and how it should be evaluated, what was the auditor's responsibility. And considering that right now, everybody is in the peak of the audit season, we thought that this would be an apt topic to ensure that the members are, the deliberations help the members in giving knowledge about the various aspects with respect to the going concern. And like I said, we have a very eminent panel today who will guide us through the questions, which would be more practice-oriented and help the members in assessing the requirements of the SA 570 are duly fulfilled. So with this, once again, I welcome all the esteemed participants to this 14th Quality Cafe session, and I wish you a very happy learning in the couple of hours from now. Thank you very much.
Thank you, sir. Now I would request our Deputy Convener, Shri Priya ma'am, to please give your insight.
Good morning, everybody, to respected past President Nihar Jambusaria ji, to my chairman, Vishal Doshi ji, who's been doing an exemplary job, not just in the Quality Cafe, but he heads possibly the most activity-filled board of the ICAI this year, in particular with the new syllabus coming in, which is the Board of Studies, to Asim Trivedi ji and Abhijit Bandopadhyay ji, who's going to join us. So here's a very hearty good morning to all of you, and this is a Quality Cafe, so I hope you have your mugs ready to, sort of be in this session, which I'm sure was going to be breezy and very meaningful. So I have only a few insights or a few perspectives to share. And when we are speaking about going concern, I think the first important thing to appreciate is regardless of the scale of the entity, this going concern assessment is very important. So whoever you're assessing, whether it's a small entity, a small company, a large company, a listed company, I think this assessment is very important. So please don't think, oh, my corporate data is just my company is just a very small company. So with only a static asset and a static liability, you have 12 crores of loans from some group company and you've given 12 crores to another set of group companies. I mean, what is there for me to assess going concern? I think it's extremely important to understand and appreciate this going concern, even if the entity that you're auditing is not a public interest entity, which means they have no bank borrowings, they may not have large shareholdings, etc. But India is a country where we've found that we've had several layers of companies and this promoter controlled 100 entities in the same mail ID and mail address. So it becomes very important. The second perspective that I thought I should share with you is until ILFS happened, I think audit was all about solvency. And I think it's very true. Even as of today, what were you expected to do? You were supposed to present a true and fair opinion or otherwise on the financial statements and the company's ability, obviously, to continue as a going concern with no material uncertainty on future operations. So I think it's in that context, you as an auditor were actually saying, okay, boss, my company is solvent, which is why you needed to make your provisions for impairment of assets, etc., etc. Because if you didn't do those impairments and assess those impairments, then your liabilities would exceed your assets, which is a classic sign that a going concern could be impaired, where your assets are insufficient to meet your liabilities. That is also one ground. So, but I think after ILFS, there have been, and we know in any context, most laws in the world are reactive and they're not proactive. They are reactive to how a civil society behaves or misbehaves in a particular context. So the Companies Act is no exception, and the changes that came in thereafter. So now you have changes in CARO, which also require you to look at ratios. Your Companies Act, your Schedule 3 disclosures require you to report ratios, etc. for all companies. I think these are also very, very important to determine your going concern assumptions. So admittedly, going concern, and my last perspective on this is, as an auditor, you're expected to be two things. One is you're expected to be at the cutting edge of trust and integrity. And I think that's what Mr. Kumar Mangalam Birla said in a meeting really long back, and that sort of stuck on in my mind. But the second most important thing you're expected to be as an auditor is to be skeptical. And this skepticism, I think, has acquired a completely different context today. Roll back to a couple of years back, we would trust and verify. Today, the landscape has changed, the contours have changed, the dialogue, the narratives, everything has changed. So you need to first verify and then trust. And it's in that context, obviously, when somebody tells you, oh, yes, we are a going concern, and we give you that fundamental assumption, I think it's up to us to verify and trust. With these few words, I'd like to hand the meeting back to the Secretary Karuna Bansali, who's also very, very enthusiastic. She's been doing an exceptional job. Thank you so much.
You are mute, Karuna ji.
Thank you, ma'am. Now it's privilege to introduce our experts, our panelists. We have in our panel our respected past president, C.A. Nihar Jambusaria sir. He was our past president in the year 2021 and 22. As president of ICI, he represented ICI on International Integrated Reporting Council, IIRC, in 21-22. He is also member of the Audit Advisory Board under the aegis of C&AG. He was a member of Professional Accountant in Business, PAIB Advisory Group of International Federation Account, IFE. He has served as member of SAFA Committee on Professional Accountant in Business, PAIB, and also served as member of Government Accounting Standards Advisory Board, GASAB, under the aegis of C&AG. Sir, we are privileged to have you in the session. Thank you very much, and we welcome you. We have another panelist, C. Abhijit Bandyopadhyay, sir. He is having 33 years of professional experience, member of International Auditing and Assurance Standard Board of the International Federation of Accountants for 3 years from 2016 to 2018. He is member of the Task Force on Auditing Accounting Estimate, ISA 540, set up by IAASB of IFAC. He has also chaired the AASB of the ICI for 6 years, that is 2010 to 2016, and he has also chaired the Qualified Audit Report Review Committee, QARC, set up by the SEBI. Welcome, sir. Welcome to the session. We also welcome C. Aseem Trivedi, sir. He is fellow member of ICI. He is specially known in country for his weekly column, Jama Punji, in Hindi National Daily Newspaper Patrika. He is having vast experience in the field of Companies Act, internal audit, auditing standards, accounting, and ethics. He also worked on training and implementation of IFRS New Companies Act 2013. He is author of various books on for CA professionals, and he has also delivered more than 1,800 seminars on ICI platform. So welcome to you, sir. Welcome, Aseem, sir. Thank you very much. Now I hand over the mic to chairman of the session, C. Vishal, sir. Over to you, sir.
Thank you, Karunaji. And like I said, that we have some very distinguished professionals on this panel. And without taking much time, I would request our past president, Sir Nihar Bhai, to give his opening remarks with respect to some early warning signs or indicators and key signals for auditors in identifying the potential risk and doubts in the management's going concern forecast. Over to you, sir.
Thank you, Vishalji. And for some time, I will keep the camera on and then put it off, as I am at a remote place and connectivity is little poor. So good morning, everybody. The convener and deputy convener of the Center for Audit Quality, CA Vishal Doshi and CA Sripriya Kumar. Let me at the outset appreciate all that you are doing for the Center for Audit Quality, keeping it live and covering topics which are of utmost importance in today's scenario. The two eminent panelists today, C. Abhijit Bandyopadhyay and C. Aseem Trivedi, and Secretary to CAQ, C. Karuna Bhansali. You have selected today a topic which is not only very important, but also very sensitive, in the sense that if proper reporting is not done on going concern and something goes wrong, particularly on account of going concern situation not being there, and in spite of that accounts are prepared on the basis of going concern, then it would really impact so many investors, so many stakeholders, and ultimately auditor would also be held responsible. You said that I should speak specifically on what are the early warning signals. So, as rightly put by C.S. Sripriya, that skepticism is very important in today's scenario. And when auditor is auditing, he should at the same time verify whether situations or conditions exist which indicate uncertainties, which indicate situation where going concern concept cannot be applied, or the accounts cannot be prepared on going concern basis. And most of the indicators are very visible on the face of the operations. Even while auditing, the auditor may observe very disturbed cash flow. If creditors are not being paid on time, if the short-term liabilities to start with are not being met, That is one indicator. If liabilities exceed the value of assets after carrying out impairment, that is another indicator. If there are other circumstances which also indicate that, take example of a company which was manufacturing some goods and which were being locally sold, and the local market has gone down, it also indicates a situation of uncertainty. Of course, these are all early warning signals which require checkup with the management. And that is why our standard on auditing, 570, casts first responsibility on auditor to verify whether management has carried out its assessment of these situations and whether that assessment of the management is appropriate or not. So when there are early warning signals, particularly during COVID time, there were signals that some of the concerns may not revive at all because the situations deteriorated to such an extent that chances of revival were very dim. So the early warning signals would appear in the regular course of audit, and the audit team should carry out this exercise on a continuous basis so that in the end, at the time of finalization, when the auditor has to take a call and make assessment of what the exercise that management has done to identify uncertainties, to even give explanations about what steps the management is planning to take. And then with these early warning signals, it will be for auditor to make an assessment. For example, suppose working capital situation is negative, the liabilities have gone up, some of the loan arrangements are coming to an end, like their due dates are fast approaching, whether these loans will be renewed, whether some borrowings can be replaced by equity, some restructuring exercise is being done. If suppose domestic demand is continuously going down, whether export markets are being explored. So there are so many factors to be examined by the management and for the auditor to evaluate whether the management's evaluation is right or not is very important, and very rightly mentioned that so far as going concern is concerned, there is no distinction between the type of entity. It could be PI, public interest entity, it could be a small entity, but every entity will have to carry out this exercise. Where in the normal course, it is apparently very clear that everything is smooth, cash flows are smooth, liabilities are within control. There are no indicators which show that uncertainties persist. In such situation, it is very different. But early warning signals would be there within the organization's regular transactions, which the auditor has to identify, visualize, and carry out the exercise for finding out whether going concern is the right concept that should be applied to preparation of accounts, or some clarifications, disclosures, or even adverse opinion is required. So, so much about early warning signals. I think I would conclude my opening remarks with this. Thank you so much for giving me the opportunity first.
Thank you, Nihar bhai. And I believe you hit the nail on the head, saying that the early warning signals with respect to various the asset liability and the ratios and all are a trigger for the auditors to deep dive into the going concern related issues. I would now request C. Abhijit Bandyopadhyay ji to kindly give his opening remarks and on the cover and the mitigating factors and the effective audit procedures in evaluating the reliability of the management's going concern forecast. Over to you, sir.
Thanks, Vishal bhai. First of all, I beg excuse because somehow my camera is not operating, and I have tried even to analyze it technically. Somehow it's not working. So, if I am audible, may I go ahead?
Yes, sir,
Yes,
you're
sir.
audible.
Okay, you have to excuse me. So, thanks, the Center of Audit Quality, the chairman, vice chairman, secretary, and my fellow colleague Asim, past president Niharji, and all the staff, secretariat. Thanks for the opportunity. Sir, my view about the going concern concept is a little more like, we need to look at the ground realities. As Neha bhai said, the early warnings, we may start from there. When I am auditing an entity, if it is a going concern, you will see that there are sales, purchases, inventory, we do control testing, we do test of details, everything will go fine. But many often we see an entity has prepared their financial statements based on the going concern assumption. This is an assumption. Initially, our first reaction to this would be to look at the loss or profit for the year. Then we see accumulated loss, net worth negative or not, current liability more than current assets, whether the company or the entity is in a position to pay off their debts or interests, and of course the debt covenants. If there are covenants, whether there are failure. These are definitely the early signals. But I think concept of going concern is much more vast, and this really does not get confined to only these symptoms. There can be a company, maybe a startup, and as per the business model, they could incur loss, and they will have accumulated loss in the very first few years. Even the net worth may be negative for the time being. These are definitely early signals, symptoms, but one has to go beyond. I would like to see it like this. Whether the entity has an order book in hand, whether they have the sellability of their product, whether even if they produce, whether they have accumulated inventory which is not sellable or sellable, whether they will have continuous supply of raw materials even in the future. If there are certain restrictions or embargo that they will not be able to service the supply of raw material, it may not be a going concern. Whether there are anybody who is not willing to pay, not only that they have failed in debt repayment or interest repayment, if there are financial institutions or banks or promoters are willing to inject more fund, it may be a going concern, even if they have failed in covenant and all. Of course, we have to be watchful on the political, geographical, and economical aspects. For example, if a particular entity is supplying a lot of materials to, say, country like Iran, and there are US sanctions, and India somehow, would be supporting that. And if there are no supply which is feasible to be made to Iran, this is an example only, no political connections. So that way, the company may not be a going concern. If the company is buying a lot of product from China and making a business, that's the main business. And if there are restrictions on import of that material from China for certain years, it may be temporary, it may not be temporary. So when I look at the management assessing going concern, one has to look at all the factors considered. Now, how do we mitigate? We have to engage in a discussion with the management. The auditing standard says that it is the management's primary responsibility to assess. The management assessment of going concern is extremely important. All the factors and early signals, as I have discussed and Niharji has said, the management will have to bring out adequate fact. Now, if there are certain events and conditions which may give rise to certain concept of going concern, the company may or may not continue, then of course the management will have to come forward and make a disclosure. They may say that there are events and conditions, but however, there are no significant doubts. There can be material uncertainty, but still the company would be able to company would be able to go through in the future period. The company may have a strong supporter in the form of promoters or the banks who will be willing to give commercial as well as financial support. That could be a strong mitigating factor. So in that case, even if there are events and conditions which give trigger, which raised trigger to go for a management assessment of going concern assumption. But still the company can show that, yes, we have a strong support financially and commercially. We have orders in hand. We are in a position to manufacture more of these goods or services, and then we get in a position to sell. And the standard says that they have the fund at least for a period of 12 months to run. The standard has not envisaged position beyond 12 months. It could be even less, but the standard says we should insist on at least 12 months subsistence. If the entity can show in a financial projection, cash flow projections, that we have enough fund to pay off the interest or debt, whatever is due. Whatever is not due, we are not supposed to pay. But we have the probable possibility of producing, selling, and collection of debts. And we can repay the liability. We'll definitely manage in a better way in the next 12 months. I think company can mitigate this, and then they have to substantiate their case to the auditors and say that, yes, we even with certain difficulties, we are passing through the test of being a going concern, subject to their disclosures as the standard has recommended, subject to their disclosures being made. Thank you.
Thank you, Abhijit sir, for highlighting the interaction of the mitigating factors and the audit procedures. And you also covered with respect to the order book, the raw material supplies, whether there are restrictions or not. And most important, that it is the primary responsibility of the management to on the going concern assumption. I would now move to Asim ji and would request him to kindly share his thoughts on the reporting considerations for auditors in evaluating the reliability of the management's going concern forecast.
Good morning, everyone. Thankful to Center for Audit Quality, Vishal Doshi ji, Shripriya ji, Karuna ji, and nice to hear you, sir, after so long. Abhijit bhai, I've worked with him on many occasions. When first Caro came out, we worked together on that particular Caro. At that time, Abhijit ji was AASB chairman. And Niyar bhai, thank you very much for giving me an opportunity to share my views on going concern. Now, as far as reporting is concerned, going concern in itself, as it is one of the fundamental accounting assumptions which is acceptable worldwide as a fundamental accounting assumption, now the things are getting somewhat changed because of liquidity crisis. And not only external, not only internal factors. Nowadays, more and more external factors are threat to the entity for having a going concern. Even if you have lakhs of customer base, even if you have acres of land and building with you, you have many valuable assets with you, still you may struggle with the going concern, and sometimes this going concern may be affected by the government policies, as now we are witnessing in case of Vodafone Idea. 282 million losses there. Still the auditor is having an unqualified audit report, and they have shown their faith in the entity as it is a going concern. Now, important is, these are all indicators, be it is negative net worth, be it is negative cash flow, be it is your borrowings are coming out for maturity, your covenants are not meeting, and banks are coming to you for on demand. So whatever these indicators are, let me tell you, these are only indicators, and we cannot jump on conclusion on the base of these indicators that what shape our report is going to take on the basis of these indicators. If you go to, if you can go in past in 2014, when the Maggie had been banned in India, and it was a very uncertain and unforeseen and unprecedented situation arose before Nestle India, that what they are going to do, because within 1 quarter they were having huge loss of millions of rupees of loss has been booked in Q3 in itself, despite of having Q2 profits. So they have Q3 losses. So there may be indicators, but indicators may not necessarily be treated as
Yeah, I think there is some.
Have we lost him?
Yeah. It seems Asimji has got disconnected. So we wait for him to join. Yeah, he has joined.
Sorry.
Yeah, he has joined.
Discontinued.
Yeah.
So I must say that we cannot jump on conclusion over these particular negative net worth or negative indicators. Whatever mitigating factors are suggested by the management, we need to look after them. That what kind of mitigating factors we are facing, and those mitigating factors whenever we are talking about. So whatever projections they are giving to us, to what is the time length of that particular projections they are giving to us, and what evidences are available to us. And after that, we need to go with the reporting criteria. Let me invite your attention towards Caro 2020, which in itself describes the material uncertainty by having an evaluation over the ratios. And they just want us to report on liquidity of the entity for next 12 months to meet its upcoming liabilities up to 12 months, which are becoming due. So that is also an indicator. So now
recording
important
stopped.
is that if we are
in progress.
If we are into that particular reporting scene where we are reporting in Caro that the ratios are not appropriate and company may not be having any liquidity to meet the obligations which are coming due within 12 months, then in itself it triggers us to have a particular material uncertainty paragraph in our audit report as per standard of auditing 570. So, and one more thing, there is an interplay between the 2-3 paragraphs. Sometimes it may happen that some annual reports are showing that there is a key audit matter, but it is specifically mentioned under standard on auditing 701 that if certain material uncertainty is there, no one should include that particular material uncertainty relating to going concern into key audit matter. Again, if a material uncertainty has been properly defined under standard on auditing 570, it should not be emphasized in the matter paragraph there in standard on auditing 706. So, as far as reporting concern is there, we need to first decide that what is the exact situation of the company where we have to report. If it is material uncertainty in going concern, definitely they have to show their material uncertainty to the notes to the accounts as note number 4 of Idea Cellular, Vodafone Idea Limited's financial statement. Note number 4 clearly mentions about the going concern and material uncertainty about going concern. If we are satisfied with that disclosure, we need to give an unqualified audit report that no, and we will invite the attention of the user through the going concern paragraph to be included in our audit report, that users' attention is invited to note number 4 of our report that there is material uncertainty, but management is assuming that yes, the going concern is still there. So this is a way how the report has to be prepared. Sometime it may happen that going concern may not be there, and management is also concerned that going concern is not there. So this is not material uncertainty with going concern. Now it is certain that the going concern is not there. If going concern is not there, again our financial reporting framework says that you should prepare your financial statement on liquidation basis, bring out all the assets and liabilities at their realizable amount, and then show it in the notes to the accounts also that you are not preparing the financial statement going concern. If they are doing that, again our unqualified audit report will be there, but now the paragraph will be changed. Now the paragraph will be according to Standard Auditing 706. We should emphasize the matter that going concern is not appropriate. So choosing an appropriate paragraph is the challenge for an auditor under this particular Standard of Auditing 570. So many public accounts we are witnessing day on day, day in, day out, that there are certain displacement of the paragraphs we witness it. So I must request everyone that before reporting over these going concern, we need to first assess what is the situation of going concern is there. Is it uncertain? Is it suspicious? Is it inappropriate? Or is it appropriate but not looking as appropriate? Sometimes it happens that the entity on the face of the balance sheet, we can say that going concern is inappropriate, while it's a very temporary situation like Nestle India is there. So there might not be anything to be addressed in audit report in such situation. So as the discussion will progress, I'm going to enlighten on all these paragraphs to be included in the audit report, and other questions are also there. So for that particular thing, I just have to say this only. Thank you very much.
Yeah, thank you, Asimji, for your opening remarks and highlighting about some real life situations, like you mentioned about the Vodafone Idea and also Maggi and Nestle, and how going concern at times can get triggered, though it as an entity, it might be a very profitable entity, but still there would be certain circumstances and situation where SA 570 would be required to be looked into. At this point in time, I would just like to, I'll share my screen and highlight on the publication that was released by the CAQ very recently, and where it was on the modifications in the audit report. It's an analysis of the modifications in the audit report. And here we can see, and this is based on the March 22 audit reports. So we had done a review at the CAQD on the annual reports for the year ended March 22 of certain companies listed on the Bombay Stock Exchange. And of them, so we did about 4,000 plus, 4261 to be precise. They were reviewed, and of which 344 audit reports were modified out of these 4,000 odd companies. And if we look, so, you know, these reports, they were across 93 industry types, and there were 318 modified opinions, 9 adverse opinions, and 17 disclaimer of opinions. But when we look on the categorization, and this book is available, this publication is available on the CAQ website, and this can be a very handy resource for our members. In fact, it's for the benefit of members that the whole analysis and publication has been brought out. And if you look at the SF 570, there were 154 audit reports where the auditors were of the opinion that material uncertainty existed in relation to the going concern status of the entity. So if we look at this breakup, it comprises almost 20% of all the conditions or the different classifications that had been done. And in terms of numbers, there were 154 audit reports where going concern either of modification was there in the auditor's report. And within going concern, if you look at the analysis of the 154 cases, almost 61% were cases where there was a net worth erosion. There are 13 cases where there was a default in the repayment, 9% cases where there was suspension or cessation of the business operations, 3% cases where there were losses that were incurred during the year, 3% where there was no business or operations in the entity, in 1% cases where the going concern criteria, it was not assessed by the company. 5% cases was where the company was in the process of winding up, and there were 5% where material uncertainty existed in case of the going concern. So we see this is the whole analysis, and the industry-wise, company-wise, audit modification, like I said, is available in that publication, which is on the CAQ website. So with this backdrop, and I would like to thank Sri Priya ji for immediately pulling out this from the publication and making it in the form of a PPT, which we could share with our participants on this very important topic. And now we move on to some of the questions.
Not intending to be, sorry to disturb, but not intending to be flattering. What I had done was just the tip of the iceberg. The entire iceberg was actually constructed by Vishalji. So he'd spent a lot of time on this publication, and I know this. So yeah.
Yeah, and like I said, it's for the members, and we would wish that members make maximum use in this audit season. Now, my first question to Niharji. Sir, how does the division of responsibilities between the management and the auditor play out when it comes to assessing the entity's ability to continue as a going concern? Over to you, sir.
Yeah, good question. I think there is absolute clarification in SA 570 itself that the basic responsibility of making the assessment of uncertainties that exist and which may impact going concern is that of management. And management will have to identify the areas where uncertainties exist, identify uncertainties that are material, and make complete assessment of whether these uncertainties would impact going concern for the enterprise. And for the auditor's responsibility is to evaluate the exercise that management has done. And the first thing that the auditor will have to do is to find out whether all uncertainties are covered. Of course, management is the right person to know what uncertainties exist. But during the course of audit, the auditor would come across so many situations where uncertainties would be indicated, and he would have noted what uncertainties, according to him, exist and require attention. So whether management has covered all those uncertainties or not, the management's assessment about materiality, whether they are material or not, and then the mitigating exercise that the management has proposed or management has indicated that it is doing. So evaluation of all this is to be done by the auditor, and this is, according to me, the division of responsibility between the two. And as always, the auditor will have to be very skeptical and will have to ascertain whether anything is not left out, and every uncertainty is covered, and those which are material, they are addressed by the management when the auditor makes the assessment.
Yeah, thank you, Nihar bhai. So you mentioned that it is the management's responsibility, definitely, to identify and also attend to all the uncertainties that are there, and whether all the uncertainties are covered in the assumptions and the projections that they would be doing. And the auditor, the responsibility of the auditor is to evaluate the assumptions that the management has made, and also whether the uncertainties that the auditor has come across have been adequately evaluated. And definitely the most important point about the professional skepticism you mentioned. My question to Abhijit ji, sir, can you dwell on the role of auditors in evaluating the reasonableness of the assumptions that the are embedded in the management's forecast? And also, as auditors, how do we balance the challenging assumptions without, undermining the management's expertise?
Thanks, Vishal bhai. That's very important, a good question. Just before that, I would like to place on record my sincere thanks and compliments to you, Vishal bhai, and the Deputy Chair, Sri Priya, and of course the office for bringing out this publication you just intimated about. I think this is very important. The auditors fraternity are doing a lot of work which go unrecognized. If this soft copy of this report and also the PPT can be sent to each and every member, and also companies, also regulators. Let them also know that there are so many cases where we have highlighted that material uncertainty existed, and thereafter they should follow up what actions the management or the companies have taken. That will speak a lot about our good work done. So compliments to CAQ. Thank you. Now the question, as you say, auditors evaluation, this is a quite challenging job. You know, when on the first question, Nihar Bhai has said that management has the primary responsibility to assess and give a report to the auditors. It does not happen in reality. You know, as an auditor, when I go and follow up, I see the early signals of losses, accumulated losses, negative net worth, covenant failure, all these, and then auditors need to ask questions. The first answer normally the management would give that our promoters are strong, or we have a good order book in hand, we are going to survive. So the assessment may not be coming to the auditors as perfect. So auditors' evaluation become more important. And particularly when there is a question of survival on the cash flow for a period not less than 12 months, the management has to prepare the cash flow and give it to the auditors. That will have number of assumptions. For example, it is cash flow which is basically flowing from EBITDA, and it will all depend on the future revenue generation. That's the sales, which is basically order quantity multiplied by the price. So auditors will have to get into the quantity and price. Often you will see the management will give a projected revenue based on a quantity which is far away from the reality which they are doing as of now or last 4 or 5 years. It will fail in the retrospective test as well. Often you have to compare. If you are, for example, they are making tire, and the company is selling, say, 1,000 units of tire in last 4 years, maybe 900, 800, 1,200. Suddenly they will make a projection that next year we are going to sell 38,000 number of tires, which is unrealistic. So auditors will have to challenge. You are saying, no, sir, we expect to sell 38. They will bring the marketing manager on board. They will bring everybody on board, and they will try to influence and convince. But the auditors will have to say, I would have said that, well, you show me the orders book in hand, where you are going to sell, where is the market? And auditors will have to have a little research or study on the market, on the industry. Is there an upsurge in the industry? Whether other tire companies are going to sell? Are they selling enough number of tires? Whether this quality of tire actually has a market offering? So one has to challenge the quantity of sales and, of course, pricing. If the price today is 100 rupees, if the projection is made based out of 500 rupees, also challengeable. So auditors first need to look at the assumption of the sales and revenue, how they project, and of course the sustainability. I might sell at 500 rupees to somebody. Is it a related party I am projecting, or it's a market trend? So they have to go back and say that other companies are also selling it at 500 rupees and 38,000. Next comes the cost. The position is assessed as on date, right? So I cannot say that I will invest another 1 crore and based out of that, I'll have a revenue generation or expenditure will reduce. If you have a board decision today to reduce, for example, I will reduce my employees by 500. Well, the impact has to be, given today. The resolution has to be done today. I cannot say in future I will do. That assumption may not hold good. So the cost entirely has to be analyzed by the auditors in the various aspects, from raw material cost, from overhead, from labor, from employees cost, from banks cost, financial cost. All those things auditors will have to get to the root of this and see that the projections made are realistic, viable, and sustainable. And that then they will get the EBITDA and cash flow, which is automatic. And thereafter, they will have to see the discount factor for calculating the present value of cash flow. That's very important. And one has to show that next 12 months, this will sustain. So, for example, if there is a comfort letter from promoters or bankers, that has to come on record. Many cases, often you will see management will confirm that promoters are very rich. They will invest money. Well, they will invest money. They may have enough money. Why should they invest in this company, which is not running well? They may not have confidence in the management. So it has to be a board resolution approved in the promoter's company. And that board resolution says specifically that we are going to give this support to them in case they need. Then that letter has a validity. And often you will see the letters are not present as on the date of signing. So auditors will have to go to the root of every assumption, challenge them, look at the realistic acceptability, and then get enough evidence, sufficient appropriate audit evidence on record before they accept it as a mitigating factor. Thank you.
Thank you, Abhijit sir. Some very important points you made about the historical data and the trends, the revenue and cost, and how to get into the root of each of the numbers and the assumptions that are being considered. Three important words that you mentioned about realistic, viable, and sustainable. Sorry. I think this sums up the responsibilities of the auditors with respect to the assumptions that have to be taken. My question to Asim ji, in continuation of what Nihar bhai and Abhijit ji mentioned. Sir, how many years projections should auditors typically consider when evaluating the management's going concern forecast? And what are the factors that might influence the projection period?
Vishal bhai, it's a very apt question and very subjective also. If we start with the Board of Directors report, the DRS, that is Director Responsibility Statement itself starts with that we have prepared the financial statement as per going concern basis. So they start acknowledging their responsibility for the going concern as per 139.5 in their board report. They are declaring that their entity is going concern. Now, very first line where they acknowledge it in their board report definitely should have some basis. As an auditor, I should ask them that, sir, you are stating this in your declaration that the financial statements are prepared on going concern basis. So what are your mitigating factors? Because as an auditor, I am witnessing so many negative indicators which are definitely indicating that the going concern may have a problem or going concern is in problem. So let me give the mitigating factor. Now they will say that we have projected a period, we have projected a cash flow, and that immediate cash flow will be cash flow for 12 months, and that 12 months from the end of the financial year. Our International Accounting Standard 1, our Ind AS 1, they all are saying that yes, 12 months from the date of financial statement would be a prudent estimate of going concern. So just have 12 months. Now our Auditing and Assurance Standard Board, International Auditing and Assurance Standard Board, and IFAC auditing wing, they have discussed on this particular matter. And one thing which came out as that when you are approving the financial statement, then only you are giving this particular director responsibility statement. So your board report is going on a particular date where you are saying that going concern is appropriate. So one has to take a view that they are saying that going concern is from the date of approval of their financial statement and not the date of financial statement. So we again need to get it that as a board of director, you have given in your director responsibility statement that going concern is appropriate. So let us have 12 months from the date of your approval. Definitely, they have, if a company has good systems, they have historical data, they can have a projection not only up to 12 months, they can have projection up to 3 years. But it depends on the size of the entity. If suppose it is startup, the whole going concern is based on the next round of finance, and auditor is witnessing in the financial statement itself that it's not going to get the second round of finance because it's not complying with the memorandum of understanding with the finances. And there are no realistic alternative available with the entity that they are going to have a going concern, because it's a huge, they have burned cash already, they have accumulated losses already. No one is going to finance them on the basis of the financial statement what they today have. And if the next round of finance and the venture capitalists and these fellows are not in talking terms because there is a deadlock between them, in that case, we would say there is no period required for any forecasting and projection. It is immediately a serious condition about the going concern. And I don't think that going concern will be pushed towards a year end. We cannot have a year end itself. In case of small business, we may not have those kind of detailed working about the historical data and the future projection. But in that case, we can have a projection limited to 12 months. So it all depends on the nature of the entity. It all depends with the sources the entity has to project about its going concern. But fairly, it should be 12 months from the date of the approval of the financial statement. First one, this. And then if management can project for more than that, we can have that also. And whatever they are projecting, they should have a basis of it. And if they are having a basis of it, we are there to evaluate them on the basis of applying our own audit procedure. Sometimes they may give us projections, which may be projections and growth, which sometimes such kind of figures come to us that we say, sir, you are projecting it, and whatever growth you are giving in your company, the growth itself is not belonging to the industry to which you pertain. So in such case, some unrealistic figures, auditor will definitely going to object on those figures, and then he will report upon them according to that. So from my side, 12 months from the date of approving the financial statement, that would be the period. If management is going beyond that, 1 year or 2 years, but it should be based on the historical figure. There should be an established trend in historical figures so that we can project it on that. But hypothetical figures, we are not going to entertain in case of going concern. Thank you, sir.
Yeah, thank you, Asimji. Like you mentioned, the DRS, we normally say it's a decision review system, but when we are talking about audit and the financial statement of company, it is the director's responsibility statement, and 12 months from the date of approval and not the date of the financial statements, the balance sheet date, but from the date of approval of the financial statements. 12 months from that should be the ideal or the minimum projection period. That should be there, the minimum projection period. And you give a very apt example about startups not getting the next round of funding. And in that case, there would be no projections that would be required. It would be immediately a going concern issue. And in fact, this 12 months, we can also see with respect to the CARO reporting, where there is a question that has been now included that whether the auditor, the view of the auditor has been sought, whether the company would be able to discharge its liabilities that is falling due in the next 12 months. So that is with respect to the period. Over here, I would just like to request our participants that in case they have any questions, they can definitely ask the panelists. So you can type in the chat box and we would receive your questions. And on your behalf, we would be happy to ask your questions to the panelists. Moving on, Nihar bhai, when a company has discontinued a business segment, what challenges might auditors face in assessing the impact on the going concern assumption? Means how would they account for the potential costs, revenues, and obligations related to the discontinued segment?
Yeah, and Vishal bhai, before I answer this question, again, my appreciation for the publication that you are coming out with. And certainly these modified opinions and adverse opinions which companies have given in some of the cases would guide the auditors, although the implementation guide is also exhaustive, but this kind of examples may practically illustrate where opinion is required to be modified or adverse opinion is required to be given. So now coming to the question that you have asked, when a company has discontinued a business segment, the auditor's challenge would be to make an assessment of what costs will fall on the continued business segment. Like when there are 2 or 3 business segments, for example, some of the common costs may have been said in the past. If one of the business segment is discontinued, that cost would permanently fall on the lap of business segments which are continued. At the same time, there would be some one-time costs when a segment is closed down. Its revenue would come to an end, but there would be potential costs for closing down also, which could be one time, and that would fall on the again continued business segment. So auditor will have to examine what will be the impact. One-time impact could be only for a limited period, but some of the costs which were said by all the business segments, which will now the share of the discontinued business segment, which will now fall on the other business segments, how adversely it will impact its cash flow and whether it would create uncertainty, material uncertainty for the going concern assumption will be the aspect to be examined by the auditor, and he can find it out from the data if segment-wise records are maintained very clearly, or otherwise the auditor will have to ask the management to carry out that exercise and present a report on the basis of which auditor then can take a call and judgment. So that would be the exercise that auditor will have to do.
Yeah, noted, Nihar bhai. Like you mentioned, that the important aspect in this would be that where the costs are shared amongst different business segments. Then where a particular business segment has been discontinued, the costs that was being borne by that segment, which would now be borne by the other continuing segments, how it would impact those segments would be one of the important things to look under the going concern. Avijit sir, when evaluating the going concern assumptions, should the auditors focus more on the company's net assets or consider the DCF or the discounted cash flow projections? And how do these two approaches, they complement each other, or what challenges might auditors encounter when using these methods?
Well, yeah, just to answer your question, of course, going concern is an assumption based on which the company will prepare the financial statements. And as it is said that it's not very easy to say a company or entity is not a going concern. When management's primary responsibility is to assess, the auditor's responsibility is also no less. And if you're an auditor, since they have not got any evidence, either from management or from anywhere, they cannot simply take a call that this entity is a going concern or is not a going concern. To report that the company is not a going concern also would require the auditors to collect sufficient appropriate audit evidence. Now, as the standard has said that you have to have a cash flow which is enough to run the company or entity for 12 months minimum, subject to what Aseem has said, that 12 months from which date and all, the company would take a stand even if we have incurred losses in the past. There can be reasons shown, and then we have there can be, there are many factors. One is that the debt repayment covenant has failed, so the technical ratios would take some time to improve. But as of now, we have spoken to the bank or financial institution, and we have got it restructured. Maybe they have deferred the repayment of installment or interest for some time. If that is so, then probably the outflow which was projected in the next 12 months could be deferred. There can be, special order they have received from somewhere which actually has to come on record. So these are all basically on the operation side. So I would say the company has to prepare the discounted cash flow to project and show that we have enough liquidity, and going concern often depends on the liquidity. They may have fixed assets and all, but where is the liquidity? So in summary, they have to project cash flow based out of operations and show, demonstrate to the auditors that the liquidity for the next 12 months is there to sustain my business, either from support from the financials institutions or from promoters, or there are some turnaround of business and all those things would need to be evidenced. So between these two, I would rather go for discounted cash flow method, because that shows the liquidity.
Right. Thank you, Abhijit sir. Like you mentioned that against the net assets value vis-a-vis the cash flow, it is the discounted cash flow that would be the preferred method or the best method to determine about the going concern ability. Asimji, there is one question from the participant which I would like to ask you, because it is in continuation of the Maggie example that you have given. So the question is that whether the going concern assessment needs to be done only at the year end, because the participant has asked that what if in Q3 there was uncertainty, but in Q4 the issue has been resolved, like in the case of Maggie.
So it's very clear that on 31st March, when the financial statements are being prepared, the basis for preparation of financial statement has to be seen on 31st of March itself. There might be some temporary issues faced by the entity during the year, which may raise a doubt about going concern, and if they have been resolved up to 31st of March. I don't think anything is required to be reported unless and until it is a quarterly financial statement. If quarterly financial statements are going to be published, and at the end of the quarterly financial statement, there are certain factors which are raising certain doubts about the going concern. As you might aware about, in 2019 itself, Idea Cellular and Airtel both have in their quarterly financial statement says that the judgment came against us in case of the spectrum fees which we need to pay, and that may definitely going to give a doubt about their going concern, which is still a matter which is raising a doubt over their financial statement about going concern. So yes, if quarterly financial statement is there, whenever the accounting period is ending and we are reporting, we need to take a call about the going concern assumptions. Sometimes it may happen that in Q3 the going concern might be suspicious, but at the end of the financial statement, everything gets in shape and the things are okay. So I would think that we need to go beyond the period end. It's a period end where we need to consider the going concern, and then we have to reconfirm it when we are financially, when we are approving the financial statement or we are giving audit report.
Right. So period end, yes, but more so at the year end that the going concern assumption has to be tested. Simply continuing with you, Abhijit ji mentioned that it would be the cash flow method that would be the, I would say, most preferred or the method for the going concern evaluation. But many times what I have been observed during the course of audit also is that there are many companies who have immovable properties, and they are often a significant asset for many companies. Now, and the companies, they do a valuation of the immovable properties to show that, in spite of the, which is carried at historical cost in the books of account, and they do a market value and say that though there are accumulated losses, but still considering the market value of the immovable property, the going concern assumption is not impaired. So in this situation, what would you suggest for the auditors about assessing the value of immovable property while evaluating the going concern assumption, and whether the choice of valuation method would impact the assessment?
Let me start with this, Vishal bhai, that immovable property we may have in two buckets. One may be as an investment property and one as a property, plant and equipment. If they are saying that we have investment properties and we will dissolve these, we will dilute these investment property and we'll get funds and then we'll infuse those funds in business and then the going concern will be okay, I'm okay with it. As an auditor, I will say, yes, you have surplus property, you will sell it out, you will infuse certain funds into business, and now you are saying that your mitigating factors are appropriate, then I will accept it. No problem. In that case, fair valuation over the investment property will be the best suited assumption. But as far as property, plant and equipment is concerned, and you are saying that my fair value of my property, plant and equipment is so high and it is not impacting my going concern, sir, if your going concern is affected, it's a trigger for accounting standard 28 in case of small entities, that's a trigger for assessing the impairment loss over those tangible assets, intangible assets, wherever you are lying with. Those immovable properties are under the scanner of accounting standard 28 relating to impairment of asset. Definitely, we have to take call for the net selling price of those assets. Definitely, we need to take call on the value in use of that particular asset, where what Abhijit Bhaiya said that we need to have the discounted cash flow by continuing use of that particular asset and the present value of the residual value which we'll have at the end of the useful life. So that value in use on net selling price, whichever is higher, will be treated as a recoverable amount. And recoverable amount which is shown by the accounting standard 28 is the best measure to value the immovable property in case when the going concern is inappropriate or going concern is uncertain. In both cases, impairment test is required to be applied, and more impairment tests will be going to be applied. I'm going beyond my question. More impairment test is required to be applied over the intangibles. Now, I'm just taking one example of this particular company because this company's financial statement are in market right now, and we are all keen to understand the company's situation. And I think Idea Cellular's financial statement are the best statement amongst before us to demonstrate how big companies that and the crises are there. So in that case also, if you look at their brand value, if you look at their license fees paid, so the intangible assets are more inclined towards the impairment. So my suggestion is that whenever a going concern assumption is uncertain, we need to go with the accounting standards of impairment. We need to find out the recoverable amount of the asset, and then that recoverable amount of the asset will be the value of the immovable property, and then we should take a call whether, because they can go with this or not. But certainly, whatever the recoverable amount is there of the asset, net selling price is not the thing which we will welcome, because if you are selling out your asset, then how can you run your business? If you are shifting your business from that location to another location, that may be one thing. Otherwise, selling out fixed asset will not be a solution for the going concern. So we need to have a discussion with management on point-to-point basis that what mitigating factors they are suggesting about immovable property.
Yeah, thank you, Asimji. So you mentioned first is to classify whether it is investment property or the property, plant, equipment, and then to also check from the AS 28 perspective about the impairment testing. And more importantly, what earlier Abhijit ji also mentioned is about the liquidity, that whether this immovable property, the management intends to liquidate in the next 12 months for the going concern assumption. My next question is to Nihar bhai. So we have been talking about the going concern forecasts and the management assumptions and all. But for an auditor, how can they differentiate between optimistic and realistic projections? And what information sources can auditors use to validate the assumptions which are underlying with the forecasts?
Yeah, very critical aspect of assessment of management's version of the going concern. Whether optimistic or realistic, even previously Abhijit ji also mentioned about the auditor's dilemma of the management's assumptions, whether they are optimistic or realistic. Let me mention that if you see today the risk analysis which is being done by organizations, they find that in terms of risk analysis, what we were doing earlier was on VUCA basis, vulnerability, uncertainty, complexity, and ambiguity. But now this has further advanced and it has become so uncertain that they say that we are living in what is called Bani world. That is brittle, anxious, non-linear, and incomprehensible. So when management has perceived and auditor has also observed that material uncertainties exist and how these uncertainties will be met with steps which management will take in the uncertain world, it is very difficult for auditor to find out whether the estimates which are given for the future are realistic or not. And here, this is the place where auditor will have to use a lot of skepticism, professional skepticism, and cross-verify whether the assumptions which the management has made are really not too optimistic to just justify going concern basis of the assumptions. And that is why every assumption will have to be critically examined by the auditor, have the proper discounting factor, and even use AI wherever it is possible, artificial intelligence to verify the data for the assumptions that are made. Because now for marketplaces, a number of analysis of so many credit agencies are available about the assumptions, which auditor may have to use and then come to a conclusion. So it is a difficult exercise, and I'm sure that it is not so easy for auditor to undergo this exercise and evaluate what management has done.
Yeah, very truly mentioned, Niyar bhai, that it is a difficult and a challenging exercise, and the auditors would be required to critically examine all the assumptions that the management has built in the forecast that they have done. Asim ji, how can auditors incorporate sensitivity analysis into their assessment of the management's going concern forecast? And is there any role that the sensitivity analysis it plays in understanding the potential impact of the different scenarios on the company's ability to continue as a going concern?
Surely, sir. Whatever mitigating factors they are giving to us, whatever forecasts they are giving to us, is need to be analyzed on some sensitivity factors. First of all, whatever they are projecting, whether they have a basis for such projection. So we need to first analyze the historical data over which they are building such projections. So whatever projections they are building, did they had a glorious past, or did they had a particular ability to, I must say, resilient in such situations? If in past these situations came and they were resilient enough to bounce back in such situation, so how they are bouncing back in such situation, or they are just a novice person in this particular field, they are just starting up the startup, they do not have more experience of that, they don't have any past experience, their past figures are also not available. So there are two terms in our I must say we have standard on auditing standard on assurance engagement 3400. We are using two terms. One was known as prospective financial statement, and one is known as forecast. And there we have a particular thing that whether figures are hypothetically stated figures or the figures are having some basic background and basic past data also backing those particular figures. If past data is backing up them, then it's okay. We will have a sensitivity analysis over there. But if a completely hypothetical situation is given there, we must be more vigilant in that particular thing, that whether these hypotheses are not mere hypotheses, because whatever they are showing to us to make entity as a going concern might not be right in their end. So I am very much concerned about the small entities and the startups rather than these big entities where we can have a sensitivity analysis. We have glorious past of the entities. We have set subscribers. There may be less number of subscribers to these telecom companies, but we know that it's a big entity which is having a sound foundation. They have a global network, they have a global presence, they have a local presence, they have in village they have presence. So it's not going to wind up so easily. In that case, we can have those forecasts which have some basic figures with us. And while going with those sensitivity analysis, we need to check out that sometimes it happens that if a financial institution is revoking its terms, and if they are saying, no, now our finance is on demand and you have to repay. Now, if one financial institution is coming and saying that you have to repay our funds, what is the guarantee that the other counterparts of that particular finance will not going to come? If a consortium finance is there and one bank is coming and saying that, no, now we need our finance back, and whatever the terms you have set in our memorandum of understanding, they are not meeting. We want our funds back. And those, as you have certain notes in certain companies, that the current, non-current liabilities have been converted into current liabilities into current year. If that start happening in a particular entity which has an established track record, if that started triggers the going concern, then their sensitivity analysis again required to be have more penetrated audit procedure, I must say. Because one financial institution is invoking its terms and saying that all finance, whatever you are having in your long-term debts, you just give it back. And the entity is shifting the long-term debts to current debts. And that definitely going to affect the other financial institutions also, credibility of the entity also, market scenario is going to be impacted by that particular financial institution's action. So if all these things are there, then we need to take a holistic approach in that particular situation, even if that entity is established and a big entity like these companies are. So that is how we need to have a sensitivity analysis in all projections.
Yes. Yeah. Thank you, Azimji, for discussing about the resilience and the ability of the company to bounce back from situations, and also about the prospective financial statements and the forecasts. Abhijit, there is a question from the audience which I would like to pose to you. Does the negative net worth with continued loss warrant qualification on the grounds of going concern, even if the company is funded through interest-free loan from the parent company?
Yeah, so I'll take the question. I said in the beginning that if you look at the events and conditions which trigger normally, every year, even if there is no symptom, nothing is there for an entity to prove that they are not going concern, there has to be a management assessment report. That's what we insist for. And the management will have to actually explain why there are no triggers. So they will, analyze the events conditions, and if there are no negative net worth, negative losses, those will be triggers. But if there are accumulated losses which turn the net worth into negative, definitely it's a strong trigger. Company itself is running into losses, but there are situations one has to understand. And just now, you actually made a very good point to Asim to answer when I said that DCA for cash flow is important, but asset is equally important. Why? Because the company may suffer temporary losses. It could be the industry is so there is a dull period going on, and it happens in US and European countries quite often. Many times they will have temporary depression, and after 3-4 years, the history says that they have turned around. Even in India, so it could depend on the industry, it could depend on the market, it could depend on many geographical, economic, and political factors. If that is a temporary loss accumulated and that turned the net worth negative, then the company would like to demonstrate that I have sources of fund. What are the sources of fund? One, unutilized sanction limit. I have got a limit of 100 crore from banks, and they are still sticking to that. So I have utilized 60, so 40 crore I can still borrow. Okay, that 40 crore would add to cash flow. Similarly, they have a strong promoter, and the promoter, as I said a little while ago, that they have resolved, if it is a company, they have to resolve in the board to show the seriousness. The board will have to resolve and give a extract of the resolution to the auditors, saying that as and when needed, we will support them financially. And the promoters' credibility also will have to be examined. It's not, I have seen in my lifetime, once they got a promoter's comfort letter, and the promoter was going bankrupt. It is not that the promoter does not have the credibility to give the money. If that can be shown, again, that adds to the cash flow. Similarly, the second part of your last question's discussion was asset. Normally, they would not like to show our cash flow arising out of sale of asset. Okay, because that would be tantamounting to liquidation. And just an asset of PP, as Asim said, fair valued, and that would not translate into cash flow. So again, this boils down to cash flow. Just fair valuing, saying that I have got 100 crore more, my net worth would be positive, and that is not adding to your cash flow. An investment property or any other property, normally they would not like to sell because that will again impact my revenue or income. So that way, asset will always take a backseat. But I have seen in my lifetime, there are, old companies having pieces, parcels of land in various places, which is either not being used or used by some other smaller entities. They might take a cash flow into their projections, showing that they will divest, they will sell it off. So it is not merely saying that I will sell it off. They will have to demonstrate that there is a clean title to sell off. It's a freehold land, no encumbrances, and I have gotten arrangement with someone who has offered me the market value, which is say 40 crore, and this 40 crore is going to happen in next 2 months. So they will have to demonstrate that this is sellable, free from encumbrances. I'm going to sell it to X. X has offered me an unconditional, that cannot be revoked, unconditional offer, or maybe they have deposited the money in some other escrow account. So then only that cash flow again can be considered, but ultimately it boils down to cash flow. So that was something we need to understand, that mere having a lot of assets or fair valuation of assets not protect me from slipping to an ongoing concern. So the promoters later also would be treated equally. If there is a promoter and they have enough fund and credibility to fund, and they have resolved to give that, and historically they have been giving, definitely that will add to my cash flow to save it from an ongoing concern. Thank you.
Yeah. Thank you, Abhijit ji. Sir, you mentioned about US, UK, and India also, where there were some cyclical ups and downs. So, can you share about what type of industries can be that can undergo such changes that impact the company's future prospects, and also, where shifts in the industry landscape which pose challenges, and how the evaluation methods to account for these changes they need to be adapted?
Oh, that's a fantastic question. Thank you, Vishal Bhai. My favorite question, because I'm doing a lot of work on industry-wide, impacts on the financials and all. Let me take you back a few years back. Most unfortunate events had happened in the form of COVID. Before COVID, when we were auditing entities, and you look at those profiles of entities, there are life sciences, there are steel core sector, there were aviation, there are hotels. When COVID came, it was like, impacting everybody's life. But during those 2 years, many of the hotels and hospital industry, they suffered huge loss. They went bankrupt, and banks were requested to give them some relief. Aviation industry was what suffered. There are many industries which really suffered a loss. And that was the time Institute had to come out with a guidance on the going concern consideration. But that was temporary. At the same time, the hospitals, life sciences actually made their fortune, right? The service sector made their fortune. So that was a temporary, you did not know that time, the visibility was not there when it is going to go away. Yes, we have also raised the going concern issue because banks were not in a position to fund them. Banks were also feeling uncertainty. But after this, now again they are turning around. A lot of aviation sector and hospitality sector, they are turning around. So that way, industry impact was huge. And today, if you ask me the question, COVID has gone, hopefully and thankfully, mercifully, that this is not going to come back. Today, the COVID in a new avatar has come, which is the impact is much more in the form of ESG and climate. Globally, there are a lot of talks. Let me tell you, we have to be very serious on this because India might have said that we will become carbon neutral in 2070, globally 2050. But it's a fact that the fuel, the thermal power company and all, they use coal a lot, steel, cement, they use coal a lot. The reserve of coal is limited, going to be eroded fast, and definitely it emits a lot of carbon. So use of these are going to be restricted. Government is under tremendous pressure, regulators and the companies are under tremendous pressure. They will have to shell out a lot of money otherwise as a penal charges. And you know what, which industry is worst affected? The chemicals, the steel, the iron industry, the gas and oil, and your cement, aluminium, which are core sector, which contribute a lot to the development of the whole country. Now in India, there are many large eminent companies working on this, and they are going to either take serious steps to make hydrogen, green hydrogen. They are talking, they are investing renewable power, but it's not easy to switch from the conventional coal and all as a fuel to green hydrogen. Even who will make that green hydrogen? Difficult to set up a plant. So in the future, I think a lot of companies will have to necessarily look at their sustainability, how they go ahead with their production. And if you switch to green energy, your all current plant and machinery will go obsolete. That will not work. At this stage, when you are paying heavy penalty and your all current use of plant machinery is going to be obsolete, whether the bankers are going to fund you, you are becoming a new industry. So I think then the going concern concept will have a new definition to see. Even the largest of the large company having a strong promoter, the promoters might like to discontinue or the company may die down. What will happen, nobody knows, but I can see a smoke, which gives me to think that because of the climate, particularly those which are having very high quotient of carbon emission, will definitely have a new definition of going concern, and they will find it difficult to, to support, to demonstrate through the financial projections, and auditors will have a difficult task to evaluate, assess, and accept or not accept the management assessment, because that will depend on a lot of conditions which are unseen, unforeseen. So we are going to have tough time in that. Thank you.
Yeah, thank you, Abhijit sir. And like you rightly mentioned about COVID, that where it was a temporary phase with respect to the going concern. And my experience also says that with respect to some of the companies which are linked with the commodities, there is a lot of fluctuations that happen in the commodity pricing, the international commodity pricing, and those companies which are linked to those commodity pricing. At times we've seen that also because the prices fluctuate, which are temporary, which are cyclical, and there would be a scenario where in a particular year there would be some may not be a going concern to that extent, but definitely some impairment that would be required, and maybe in a couple of years back that impairment needs to be reversed because they are linked with the international commodity prices and that has bounced back. So we've had a lot of discussions on this, and now I feel that since we are into the last half an hour, we should move to the reporting. And my question to Nihar bhai over here is, sir, that after conducting the assessment, how should auditors communicate their findings regarding the reliability of the management's going concern forecast to the stakeholders, and what level of detail should be provided in the auditor's report?
Yeah, I think this is a very good question, but I would, before answer this question, because it is related, I would reflect on what Asim ji and Abhijit ji said, that particularly for older companies, there would be past records of being resilient. But at the same time, what Abhijit ji said, that another version of COVID is climate change, the manner in which landslides, floods, and everything is happening. It creates so much of uncertainty that we don't have the past history to verify whether such an event occurred and in what way the same organization could react and reflect and recover out of it. So what I mentioned, that Bani kind of situation where N stands for non-linear, most of the uncertainties that we see today look like non-linear. There is no past history and it is very difficult to communicate. And in view of this, the reporting that auditor has to do is very significant. Like if it is not properly reported on the going concern, the manner in which the other regulator takes upon the auditors, although standards on auditing are followed, they come out with their own circular and interpret in their own way. I think auditor has to be very careful in reporting. I would say that the entire assessment should be incorporated as a part of the report. See, anyways, under SA 570, separate assessment is required to be given. So there, incorporate the assessment in detail, which is necessary. Provide the context. So the auditor should specify there as to what is the concept of going concern, what is the role of management, what is its responsibility, and how the auditor then made and carried out his assessment of the management assessment. Auditor should summarize his role very, very clearly, like explain the role of auditor in assessing management's going concern forecasts. Emphasize that the auditor's responsibility is to obtain reasonable assurance, and it is not finding completely fraud, error, misstatement everywhere. State the conclusion clearly. The conclusion should be clear. If he agrees with the management on going concern that it is not impacted, state that clearly. And it should not be in ambiguous language. It should be clearly stated. Even provide the basis for conclusion. After evaluating management's assessment, even whatever conclusion the auditor arrives at, that whether he accepts that going concern is not impacted, what is the basis for conclusion? And if he comes to the conclusion that no going concern is impacted, then very clearly he has to give qualification or emphasis of matter. And if the auditor concludes that there are material uncertainties about company's ability to continue, there should be this should be very explicitly stated in the auditor's report as a qualification or as an emphasis of matter. And disclose assumptions and limitations. I will again repeat that the other regulator is asking questions on everything. So whatever assumptions have been accepted should be disclosed clearly in the separate reporting. and maintain professional language and tone so that the responsibility does not unnecessarily fall, although everything is clarified. I think this is the manner in which the auditor will have to report even additional disclosures if they are required, like depending on the circumstances. The auditor's report may also need to include some additional disclosures about company's financial position, significant risks, uncertainties, the way auditor feels, which is a departure from what the management feels. And ultimately, the auditor's report should provide stakeholders with a clear picture of what is this assessment. And a balanced view should be presented in the auditor's report. Yeah.
Yes, right. I think, Nihar, you made it very, very clear that there should be no uncertainty with respect to reporting on the going concern certainty or uncertainty. I would say that that has to be very, very clearly reported in no uncertain terms, whatever are the findings, whatever are the assumptions, and whatever are the conclusions in the auditor's report. So I would now like to be a bit more, I would say, personal in the sense about sharing some real life experiences with all our panelists. So starting with Asim ji, sir, can you share a lesson that you have learned when it comes to assessing the reliability of the management's going concern forecast and how this has shaped your approach to future assessments with respect to going concern?
I'm just sharing one incident that one of our clients who was into the soya oil manufacturing during COVID times, and there were tough times with that particular entity also. It was a blending of soya oil and in the same company they are producing the soya oil, and in the same company they are producing the fertilizer. As far as fertilizer concerned, both the business were there, both the business segment were serving to a common man, and during this COVID tough times, the things were not in good shape. So the entity was struggling. Although before COVID, it was struggling to its going concern, but that outburst of COVID definitely brought that particular entity to definitely going to be end. And everybody was saying that the going concern is not there. We were pretty sure that going concern might be in a problem, and this year the financial statement will definitely take a call over the going concern assumption. And then we started discussing with the management, and they were saying that we have holding company and we have certain finances from Dubai, and as our promoters are from Dubai, they are definitely going to finance this particular entity, and they are infusing the funds, and they are going with some expansion also. They have came out with certain memorandum of understanding with the big companies over to whom they can lease out some of their facilities to lease out the other oil manufacturers. So they came out with a detailed explanation and everything. Then we started taking call one by one that if this is memorandum of understanding with this particular entity which is going to give you outsource the capacity. Now we had one call that if this entity is going to take up this particular facility as an outsourced facility, this particular entity has already having 4 or 5 plants in Madhya Pradesh. So why they are interested in taking over this particular entity? And it seems that they have good relationship with that particular entity, which is also oil manufacturer and distributor, and that particular lobby is there. They all were started doing one thing, that they are giving a letter of intent to each other, that we will to show the auditor as a going concern, they are giving letter of intent to each other. So everyone is producing the LOI of the other that we are going to support you and we are going to facilitate you. We are going to take out your capacity as our refinery. We will take out refinery on lease. We will take out the crude oil on lease. So that particular capacity is there. when we came to know that everyone is going this kind of letter of intent to each other to just show the comfort of the business and just to have a, I must say, that's a case of fraudulent financial reporting, I must say, about the disclosure of going concern, because they were all in a problem and they are showing this kind of letter of intent. Then suddenly we had a discussion with management, which were in Dubai. Those are the promoters. We were having a discussion with them. We had a communication with them that how you are planning to infuse the funds, how you are taking a call over the outsourcing of these. One side they are saying that you are infusing the fund, other side they are taking out the letter of intent from others. So what is the exact clarity about that? And then the Dubai management, that those promoters clearly mentioned as that, sir, see, we are just exploring the options. It's not sure that we are going to invest into this particular company. We are just exploring the other options. We have 3 more producers of oil manufacturers. There are 3-4 oil manufacturers with whom we are in talking to have the facility outsourced and all. And it's all, nothing is certain. Even every option, whatever they are telling to us and producing the evidence, we got to know that nothing is going to happen, and then a material uncertainty paragraph is required to be inserted in their audit report. So definitely clarity is required from the management itself, and whatever they are saying, if they are saying that promoters are going, let's have a clarity from promoter itself, because the local management is definitely going to show that the going concern is appropriate, and they will give us some false evidence like that letter of intent they are giving to each other.
I think that was I would say, an eye-opener for all our participants that, going concern is just not taking a forecast and filing it. It is going deep into it, going into the numbers, going into the assumptions, professional skepticism that all our panelists have stressed upon, investigating and I would say questioning the management on various aspects, and that is how you should approach the going concern. Abhijit, I know you would have had a lot many experiences during your journey as an auditor. Sir, what would you like to share with our participants that they can take home in this audit season?
Yeah, I have some experience. Particularly, I would recall one experience where, we have actually raised signals. And as you know, the management will have to basically come out clean. They have to play honest. They have to make an assessment. And it's not that something is going against the company. Let us understand, if there is a concern on the going concern assumption, it is actually for the benefit of the company, for the benefit of the shareholders, it should come out in the open for discussion. I'm not saying it has to be translated into audit report or somewhere. So if there are events, conditions that should be charted out. So I have one experience. I know that was a tire industry company. They used to make tires, and it's very essential to know that they are making 2 types of tires. One was the conventional bus tires, and the second one was the radial tires. Nowadays, almost the entire global industry are making radial tires. And if you have a car, you know that you also buy tires which are radial tires. There is a still, built into that. Bias tires used to consume a lot of rubber. So only in India and some countries like this are still using bias tires by the large, huge buses and all. But technology has changed. So there was a negative kind of, projected demand. And naturally, the company also started losing the orders. In spite of that, when we talked about the projections, we spoke about the evaluation of projections, reliability, auditor's duty. So that projection also was made very optimistic. And the past track record were not supporting, right? So one has to be very careful. One need to know it's not only tire industry, which type of tire they are making. Radial tire, if they have a projection, definitely it's acceptable because there is a market. And all the other tire companies in this industry in India, they are making radial tires, exporting. There's a huge market. Instead of that, if you are projecting based on the past as where the design has changed, the IT, the technological development has come in, and you still want to make projections of say 45,000 tires, 60,000 tires I'll sell. So that goes into the root of the projection, which is not reliable. Second, the cost. Where from do you get so much of rubber? And because this the rubber produced in India is not very convenient for the tire. So one has to import a lot of things, and the carbon black, which also a lot of percentage of the carbon black is imported, not produced in India, because the high quality comes from there. That has a cost. And for running the whole operations, you have to borrow fund or promoters have to fund. Now, initially you go to bank, there are unutilized sanction limit they have used. Thereafter, since the banks were not getting even their interest, or sometimes they get interest, they are not getting principals, they said no further loans. Sorry. Even the bills discounting was stopped. So one by one parameters, if you see, there's the demand is not there, which I was saying in the beginning. Orders in hand are not reliable. Even if you have an order of 45,000 procured from someone, that cannot be really accepted as evidence. Then the cost is going up, your profit margin is under stress, and nobody is going to fund. Then the next step was like somebody is going to fund, who will take equity. Where is the reliability or credibility of that fund? There could be an agreement signed, maybe an MOU is signed, but it has to be an unconditional agreement which is non-revocable. And the promoters who's trying to invest money, I mean the future promoter, will have to demonstrate their credibility. Where from they get fund? Are they in the tire industry for a longer time? So all these factors were considered, and finally we told the management boss, tomorrow proposition nahi banta hai. Events conditions are there, they agreed. Whether significant doubt is there, yes. Material uncertainty is there. Now the mitigation was important, which the management gave us a projection and talked a lot. Finally, we said the standard on audit 570 says that you have to bring out in the notes on disclosure adequately. So if there is a material uncertainty, but you have a support from promoter or bankers, the bankers accepted actually a one-time settlement, and bankers said that we are going to be there because of some other background and all. So the bankers have not rejected, and they are still considering they are going to fund. At least you have one source, and that one of the persons who wanted to invest in equity has a credible, background. So with this, they proved that material uncertainty exists, but the going concern as of now is not stopped. It cannot be called totally a not going concern, and they have a huge land and property plant equipment, which you were mentioning. And the latest radial tire manufacturing plant machineries are highly, marketable. So with that background, the company had to, was told to come out with an adequate disclosure about the events conditions, about the uncertainty, about the strength and weakness, everything, so that the shareholders and the public and the regulators get the right picture. If the standard says if they come out with adequate disclosure, stating their weakness and saying what are they going to do, if the auditors are satisfied, they may give a clean opinion. They may not mention anything in the report. That's what, and otherwise down, since you are having a paragraph on going concern, the auditors will have to mention in their paragraph. But it is very clear in the standard, if the disclosure is not adequate, then auditors will have to qualify, even issue an adverse report. If the management does not want to do the assessment, neither give any information to the auditors will have to give a disclaimer. These are all written very clearly in SA 570, and as well as they refer to 705. So very clearly one has to follow that. And the auditor, if they do not get anything, and I'm not talking about in my given cases, maybe some cases may come that auditors think that even after this management, whatever they're claiming are not reliable, I think auditors will have to give an adverse report on the entire balance sheet if they prepare the financial statements based on the going concern assumption. So auditors, have the weapons, have the recourse through the audit report. But before that, I think what is important is one has to challenge with a high skepticism. One has to have enough information about the outside the company, about the industry, about the market, to challenge those forecasts and projections, and then come to a conclusion and go back and discuss with the management first. And of course, they must discuss with those charged with governance. Thank you.
Thank you, Abhijit, for that. I would say sharing your experience and also on the audit reporting. And I think one important takeaway when you were narrating the whole experience of yours was knowledge about the client's business, which is so important. When you were mentioning about the tire, the type of tire, the imports, what is happening worldwide, what are the technological developments that are happening. So, management might say that last year I manufactured and sold X quantity, and in the projections they still maintain that X. And we, as auditors, we cannot become complacent, find that they have not given a growth, 10%, 15% growth. So it's the same number as last year. So I would accept it. That would not be the scenario, because technologically maybe that X might not be achievable in the what has been forecasted in the next year. It might be something X minus something because of the developments that are happening in the industry or with respect to competition and all. I think that is something very important as a key takeaway, which I would take from the one of the key takeaways that I would take from when you were sharing your experience. And now I would turn to Nihar Bhai. Sir, your final words of wisdom and guidance for the audit fraternity on this going concern.
No, I would rather say that every member, every auditor should be very careful about his or her duty. And we have these standards on auditing. We have implementation guide available for the benefit of members. This should be fully utilized, and as mentioned, the skills that we have acquired during our practice, the members must fully utilize that skill for the purpose of making the assessment, coming to conclusions, reporting adequately, and at the same time raise questions where there are doubts. The two panelists have explained their experience on the ground as to how sometimes client may present data which is not reliable. And there the professional skepticism, the full intelligence and skill set that a chartered accountant has acquired during all these years of practice should fully be put to service, and accordingly appropriate reporting should be done. That is the only conclusion we draw from the entire discussion. And it was really fruitful for me also to know from the other panelists what are the other views on going concern. Thank you so much.
Thank you, Nihar Bhai, for your kind words. And I really feel this has been a fantastic session, because going concern typically, I would say, for the audits is a challenging area, but as well as an overlooked area. I would not say a neglected area, but an overlooked area. And I think the deliberations that we have had today with each of the panelists, sharing their experiences and giving the nitty-gritties of the whole topic, I think all the members today have been empowered and equipped appropriately in discharging their duties under 570 and also in this audit season. So with this, once again, I thank all the panelists for sparing their valuable time and giving the insights on the topic. And I would now request Secretary CAQD, CA Karuna Bansali to kindly propose a formal vote of thanks.
Thank you, sir. Indeed, it's a pleasure for me to extend a sincere and warm vote of thanks to some truly exceptional individuals who have contributed significantly to the success of this Quality Cafe. First and foremost, I would like to express our deep appreciation and thanks to our esteemed, respected past President Nihar sir. Sir, your visionary leadership and tireless dedication have left an indelible mark on our organization, ICI. Under your guidance, we have achieved remarkable milestone, and your commitment to excellence continues to inspire us all. my thanks to our esteemed past Central Council members, Abhijit sir. Sir, we extend our gratitude for your invaluable guidance throughout this Quality Cafe session. Your ability to steer discussion, encourage engagement, ensure the smooth flow of information, and your insights on the topic has been instrumental in making this event a resounding success. I also wish to extend a special thanks to Asim ji, Asim sir, our third expert panelist, whose insights and expertise have enriched our discussions and provided a broader perspective on the matter at hand. Your contribution have added depth to our understanding and sparked meaningful conversations. The success of this cafe session would not have been possible without the vision and guidance of chair of the session and convener CAQD Vishal sir and deputy convener Shri Priya ma'am. I would also like to convey my thanks to my CAQD team and technical support staff. Last but not least, I extend my heartfelt thanks to all of you, our participants. Your thoughtful questions and active engagement have made this cafe session truly dynamic and enlightening. Your presence here today reflects your genuine interest in culture of learning and collaboration. Now, as we wrap up this session, let us carry forward the knowledge shared here and the connection formed to continue striving for excellence in all our endeavors. Thank you once again. Active engagement have made this session truly dynamic and enlightening. Your presence and each and every one of you. Let's continue to grow, learn, and inspire. Thank you. Thank you very much. Thank you, sir.
Thank you. Thanks to the Center of Audit Quality.
Thank you. Thank you. Wishing everybody a great weekend. And we have the next Quality Cafe session on the 9th of September.
Thank you, sir.
Thank you.
Thank you.
Thank you.
Thank you. Thank you, sir. Thank you, everybody. Thank you, Niyar bhai, Abhijit da, Asim ji. Thank you. Thanks, Karuna.
Thank you, sir.
Thank you. Thank you. Bye.